In the cutthroat arena of high finance, a titan is stumbling. Barclays, one of Britain's most storied and powerful banking institutions, a name synonymous with global commerce, is dramatically falling behind. After a roaring and profitable 2024, its share price has hit a solid brick wall in 2025, now lagging almost every single one of its major rivals on the prestigious FTSE 100 index. It's a shocking, almost unbelievable turn of events for a financial behemoth that once seemed invincible. And while Barclays falters, its arch competitor, Lloyds, has been on an absolute rampage. Lloyds shares have rocketed upwards, surging by a breathtaking 40% since the start of the year. This isn't just a small gain, it's a market-shattering performance that has left investors euphoric and competitors envious. This stark divergence sets the stage for a monumental investment showdown. Are we witnessing the slow, painful decline of a giant, crumbling under the weight of its own complexity? Or is Barclays a deeply wounded beast, coiled and ready to strike back, presenting a once-in-a-decade buying opportunity for those brave enough to seize it? And is the meteoric rise of Lloyds sustainable? Or is it a dazzling bubble, stretched to its limit and waiting for the slightest pinprick to pop? Today, we are embarking on a deep financial investigation. We will pull back the thick velvet curtain on these two banking heavyweights, dissecting their every move, exposing their hidden weaknesses and uncelebrated strengths, and ultimately determining which of these stocks truly represents the superior value for your hard-earned money in the challenging landscape of 2025. The question is simple, but the answer is incredibly complex. Which banking king truly deserves the crown? Before we can properly judge our contenders, we must first survey the treacherous battlefield on which they operate. The year 2025 is proving to be an economic minefield, fraught with peril at every turn. Inflation, the persistent and silent thief of purchasing power, remains stubbornly high, hovering around a worrying 3.4%. This has forced the Bank of England's hand, compelling it to keep interest rates locked at a restrictive 4.25%, a level that makes borrowing more expensive for everyone, from first-time homeowners to the largest corporations seeking to expand. This creates a pressure cooker environment for the entire economy. Overlaying this domestic pressure is a global tapestry of deep-seated anxiety. Geopolitical storm clouds are gathering on multiple fronts, from the relentless and draining conflict in Eastern Europe that ripples through energy and food prices, to the seismic political uncertainty brewing in the United States ahead of a critical presidential election, which could upend global trade and alliances overnight. This potent cocktail of risks has, quite understandably, sent a wave of caution washing over investors who are now favoring safety over speculation. For the banks, this environment is a classic double-edged sword. On one hand, those high interest rates have fattened their net interest margins, the profitable gap between what they pay out in interest for deposits and what they earn from lending. But on the other, far more terrifying hand, the specter of widespread loan defaults haunts the entire sector like a recurring nightmare. In a fragile economy, teetering on the edge of a potential recession, the risk that businesses will fail and individuals will be unable to pay back their debts is an ever-present, growing threat. This is the high-stakes, high-wire act that both Barclays and Lloyds must navigate to survive and thrive. Now, let's bring our first contender into the ring. In the blue corner, weighing in with a market capitalization of a colossal £48 billion, we have Barclays. This is not just any bank. It is the second largest in the entire United Kingdom, a global financial force second only to the mighty HSBC. And true to its heavyweight status, Barclays is not sitting idle. It's making bold, aggressive power plays. It is currently locked in a fierce, head-to-head battle with Santander as one of the two final bidders for Sabadell's UK arm, TSB. This isn't just a simple acquisition. It's a statement of immense intent, a signal of enormous ambition, and a burning desire to dominate the domestic market. Should it succeed, it would dramatically reshape the UK's retail banking landscape. When you peek under the hood at its recent financial performance, the numbers are nothing short of extraordinary. Revenue has climbed by a very healthy 9.8% year-on-year. But the figure that truly makes you sit up and take notice, the number that demands attention, is its earnings growth, a mind-bending, explosive 110%. This incredible surge has been fueled by a golden era of trading conditions within its formidable world-class investment banking division. Its operational efficiency is also in a class of its own. Boasting an operating margin of 31.5% and a net margin of 20.4%, Barclays stands as the most profitable of all the major UK lenders. It's a finely tuned money-making machine, firing on all cylinders. And if that weren't enough to entice you, its valuation seems almost too good to be true. The Barclays share price currently trades at a price-to-earnings, or PE ratio, of just 6. Let that sink in for a moment. For a company of this immense scale and blistering profitability, a PE of 6 is practically unheard of. It suggests the market has completely overlooked its potential, pricing it as if it were a company in terminal decline. Furthermore, its price-to-book ratio sits at a lowly 0.8, which means an investor could, in theory, purchase the bank's entire asset base, its buildings, its loans, its technology, for just 80 pence on the pound. It is, by a wide margin, the most cheaply valued stock in the entire sector. It screams deeply undervalued bargain from the rooftops. But, as every seasoned investor knows, when a deal looks this good, it's time to look for the catch. And with Barclays, the catch is a monster lurking in the shadows of its balance sheet, a truly terrifying mountain of debt. We're talking about a staggering £176 billion in liabilities. To put that into perspective, that is almost triple the bank's entire equity base, and substantially higher than its key rivals, Lloyds and NatWest. While high leverage is part of the business model for large investment banks, this level of debt acts as a powerful, unforgiving amplifier. In the good times, it juices returns and makes the executives look like geniuses. But in a downturn, it magnifies risks exponentially. A small economic tremor can trigger a financial earthquake within the company, potentially wiping out shareholder value. It's a high-wire act performed without a safety net. Then there is the matter of the dividend. For income-focused investors, the yield is a rather uninspiring 2.5%. Yes, it's a positive sign that the payouts have been consistently rising for 4 consecutive years, including a 5% hike this year, but it simply doesn't compete with the income on offer elsewhere. The risks facing Barclays are therefore crystal clear. Its heavy dependence on the notoriously cyclical and unpredictable world of global investment banking, the ever-present threat of stricter regulations, and the potential for billions in unforeseen costs tied to its ambitious expansion plans, like the TSB acquisition. It's a classic high-risk, high-reward proposition that could either lead to spectacular gains or devastating losses. If you appreciate this level of detailed financial breakdown, please take a moment to hit that like button. It sends a powerful signal to us to keep creating in-depth content just like this. Now, let's pivot and turn our attention to the market's current champion, Lloyds. If Barclays is the flashy, temperamental, high-maintenance Formula One car, then Lloyds is the powerful, reliable, go-anywhere Range Rover. Its financial figures are certainly more modest, but they are built on a foundation of unshakable stability. It reports an operating margin of 23.8% and a net margin of 15%. Solid, respectable, and predictable numbers. One notable area of relative weakness is its return on equity, which at 8.7% is the lowest among the big 5 UK banks. But here is the critical, defining difference that sets Lloyds apart: its fortress-like balance sheet. Lloyds carries significantly less debt and possesses a much stronger, healthier equity position than Barclays. This conservative, prudent approach means it is built on a foundation of solid rock, not shifting sand, making it inherently better equipped to withstand the economic hurricanes that may lie ahead. The Lloyds share price is not as jaw-droppingly cheap as Barclays, trading on a PE ratio of 8.8 and a price-to-book ratio just shy of parity at 0.97. It's reasonably priced, but not a bargain basement find. However, the real story, The compelling reason that has investors flocking to Lloyds is its dividend. Lloyds offers a fantastic, juicy dividend yield of 4.2%. For any investor whose goal is to generate a steady, reliable stream of income, this is a massive green flag. It's a tangible return you get for your investment, paid out in cash, quarter after quarter. Better still, this isn't a one-off. The payout has a proven track record of growth, having increased for 4 consecutive years, climbing by an impressive nearly 15% year-on-year. This signals huge confidence from the management team about the bank's future earnings. This is the kind of reliable, growing income that can become the bedrock of a successful long-term portfolio. But Lloyds is not without its own skeletons in the closet. The biggest and most ominous risk is a storm cloud gathering on the horizon, the ongoing, wide-ranging investigation into the mis-selling of vehicle finance. The entire industry is holding its breath, bracing for what could be billions of pounds in regulatory fines, reminiscent of the PPI scandal that cost the sector tens of billions. As a major player, Lloyds could be on the hook for a very significant sum. Such a penalty could take a huge bite out of its profits and derail its dividend growth story overnight. Beyond that specific threat, its tight focus on the UK consumer makes it highly sensitive to the rhythms of the domestic economy, including borrowing trends, consumer confidence, and the health of the housing market. A sharp UK recession would hit Lloyds harder and faster than its more globally diversified peers. So, we have our two combatants, each presenting a completely different path for the potential investor. On one side, we have Barclays, the undervalued global powerhouse with explosive growth potential, but burdened by terrifying debt and the volatility of investment banking. On the other, we have Lloyds, the surging domestic champion, a dividend-paying machine with a rock-solid balance sheet, but facing a massive potential legal bill and tied to the fate of the UK consumer. The choice encapsulates a fundamental investment dilemma. Do you bet on the high-octane growth story of Barclays, hoping its sheer profitability can conquer its immense leverage? Or do you opt for the steady, income-generating security of Lloyds, hoping it can successfully navigate the legal storm ahead? In the final analysis, considering the profound uncertainty of the 2025 economic landscape, the author's verdict leans decisively towards one of these contenders. While the deep value proposition of the Barclays share price is undeniably tempting, the combination of its extreme leverage and its exposure to the whims of volatile global markets makes it a significantly riskier bet in a fragile world. It's a bet on everything going right. Lloyds, despite the dark cloud of the finance probe, presents a more compelling and prudent case for the thoughtful, long-term investor. Its superior dividends yield offers a concrete, immediate return and a reward for your patience. Meanwhile, its stronger capital base provides a crucial buffer, a financial shock absorber that offers invaluable peace of mind when economic turbulence inevitably hits. The final verdict, therefore, falls in favor of Lloyds as the better value, more appealing stock for today. Its blend of income and stability appears better suited to the challenges ahead. Barclays may indeed offer more explosive upside, but the journey is likely to be a white-knuckle ride with a much wider range of potential outcomes. Your choice ultimately depends on your personal tolerance for risk versus your need for steady, predictable income. So, we turn the final question over to you. Which of these banking giants would you back with your own money? Are you enticed by the high-stakes gamble of Barclays, or does the dependable income stream from Lloyds win your vote? Share your reasoning in the comments section below. And if you haven't already, please subscribe and hit that notification bell. That way, you'll never miss our next deep dive into the companies and trends shaping our financial